This first chart you got the Bitcoin Nasdaq futures 28-day rolling correlation. What is this showing us here?
Yeah, so this is technically, it's like 672 hour, but 4-week rolling correlation at 93%, 0.93. So basically tick for tick, even though the scales are a little bit different. Wherever the Nasdaq goes, Bitcoin goes. Essentially, Bitcoin, for Bitcoiners, it's treated as a risk-off asset. It's a monetary safe haven. But increasingly over 2020, 2021, it's been adopted by macro allocators, and it's treated to them as a risk-on asset. And so, I think there's somewhat of a bigger picture being missed. But that's opportunity for everybody that's happily stacking away. So if someone wants to sell Bitcoin because of auto correlations and just a volatility model, right? The VIX spikes. Look at every time the VIX locally spikes. I believe I put the chart in, but every time the VIX has spiked, if we look in in a big way, March of 2020, but even like local kind of VIX correlations.
Right here is the March. Right here is the March 2020. You can see that big drop in price.
Yeah, and that's the big one. And then we have an even kind of a more zoomed up version. And you can see kind of the last 2 months have basically been every time there's been a spike in the VIX, the volatility index for the S&P, risk off in equities, Bitcoin's kind of hit somewhat of a local bottom, or sold off in a way. And so there's obviously its own variables in the Bitcoin market. There's derivatives, there's its own traders that don't even probably look at equities. But for the last 2 months, really the tail of the tape has been Bitcoin is being treated as a risk on asset. And when things go risk off, Bitcoin takes a hit. And so, that's where we are in the monetization phase. It's treated as a check on central bank irresponsibility. And if central banks become marginally more responsible, which the markets have kind of priced in as a probability, then Bitcoin's gonna take a hit, and that's fine.
And so when you think about correlation between Bitcoin and some of these other Nasdaq, et cetera, type assets, is Bitcoin the leading indicator or are the stocks the leading indicator? Like, do you have a sense for which one is leading the other, or they're just moving in lockstep and it doesn't actually matter? They just go together.
Yeah, funny enough, I think Bitcoin has actually become more of a pure signal in terms of like risk on, risk off. It seems like it's a more of a free market. Obviously, there's a lot more capital in these equity markets, and it's like a lot of it's kind of just auto allocated by pensions and all of this, where they just need to establish some sort of allocation and lock it in. There's tens of trillions of dollars of assets in these equity markets where Bitcoin is an even $1 trillion asset. And so funny enough, when we saw the VIX spiking, I believe 2 weeks back, hit like 38, and it was really bloody Monday. And then the following Tuesday after, where equities closed in the green both times with the Nasdaq down like 4.5%. Bitcoin bottomed first both of those days. And we could see like in the spot order books that there's some huge buyers on Coinbase just happily stacking away in huge volumes. And so what that kind of tells me is, the correlation is obviously there, but Bitcoin is being increasingly viewed as, this more pure signal of the kind of a check on the financial system and how unsustainable it is. And so it's almost like a leading indicator. We saw that in March of 2020 as well. Bitcoin obviously is much more volatile, 50% in a day, but it bottomed 2 weeks before equities, and it was up 40% by the time that equities ultimately bottomed in that March 2020 moment. So that's kind of how I think of it going forward. Is the volatility spike done? Are we going to see a liquidity crunch in 2022? Maybe. And if anyone tells you they know, they're just lying. But ultimately, I think coming out of it, how the response is after some sort of liquidity crunch, that's where Bitcoin really takes off.
Got it. And then when we start to think about some of the other instruments around Bitcoin, let's look at the perpetuals funding rate versus kind of like an annualized basis. What are you seeing there?
Yeah, so we talk about this a lot, but here we actually took like an annualized figure of it. So in Bitcoin, there's a couple different type of futures instruments. There's that perpetual futures, which is just a futures contract that never expires, it just rolls over. And then you have like the quarterlies, which is more in line with like traditional commodity future markets, right? Like every 3 months, there's a quarterly futures expiry. And so we can take like the spread between the current spot market and what that futures price is, and we can have like a basis spread. And so if we annualize that, we kind of get like almost a market neutral or risk-free rate in the Bitcoin markets. And so during April, that was hitting like these really, really high figures, like 40%, 50% plus. In those perpetual swap markets, basically, it's kind of this basis between the spot price and that the funding essentially keeps incentivizes allocators to remain tethered to that spot price. And so if the derivative is trading far above the spot market, funding will be really, really positive. So this is a 168-hour moving average of that perps funding, and it's annualized. But basically, what you see in February there is that traders were paying 100% annualized to long Bitcoin. Right. So obviously that's not sustainable. It kind of shows you that these capital markets are the wild, wild west. But for some investors, it was a really big opportunity. You got paid, outrageous rates to just short Bitcoin. And you could not even short it with your entire net worth. If you 1x short Bitcoin, you're holding a synthetic dollar. So you could harvest 50%, 100% annualized yields for a week on end for just sitting in dollar positions. And so, we can kind of see these boom and bust cycles in Bitcoin with on-chain indicators, but we can also see it and kind of the sentiment cycles in the Bitcoin derivatives market. And right now, we're basically completely muted. We're not severely negative, but over the last week, perps funding has been on average negative. So what we really kind of see is it's not derivative driven at all. And actually all kind of long speculation has basically been driven out over the last 2 months.
Got it. And so when you see us down kind of flat, do you think we have to go super negative before we get any sort of upward price movement? Or how do you think about funding being positive or negative in price?
Yeah. So, usually in bull markets, it's always different. This time it's different. Everybody longs their longs. You see the basis futures funding, it explodes upwards as everyone's just trying to margin long Bitcoin, margin long crypto. And during bear markets, you saw the same thing at the bottom of the 2018 cycle. Everybody thinks Bitcoin's dead. It's all over. They're longing the absolute, or they're shorting the absolute bottom. And you see that the perps market drives far below the spot market. And so it's almost like the derivatives are trying to push that volleyball underwater. That's how I describe it. They're pushing a beach ball underwater, where naturally that spot market is that gravity or physics is going to take over, and we can't really go any lower. And so we're not at that total capitulation phase yet, where derivatives are driving us into the dirt. But most of that speculative air has been kind of sucked out of the room. And so right now Bitcoin seems to be pretty fairly priced from a derivative side of things. And I think, depending on equity correlations, we can see some higher prices here, but that long kind of speculative activity that we see a lot of times in Bitcoin cycles, it's really not there today, which is actually a really good sign for bulls.